Welcome back to the video, guys. Now that we've got past the numbers for the month, we're only a couple of weeks away from the next set of numbers, but I thought it'd be good to get back to the education side of things. And I wanted to start off with looking at some infamous sort of investors and some of the quotes that they typically share with the wider investment community. And I want to start off with a chap called Benjamin Graham. He was between 1894 and 1976, and he's coined as the father of value investing. Who is Benjamin Graham? Benjamin Graham was an American economist, professor, and investor. As I said, he was widely known as the father of value investing and the dean of Wall Street. His investment philosophy emphasized investors' psychology, minimal debt, buy and hold strategies, fundamental analysis, and concentrated diversification. His most famous students were Warren Buffett and Irvin Kahn. As I said, his key concept was margin of safety. His masterpiece was The Intelligent Investor, and his philosophy was value investing. So what were his 16 principles of value? So these are quotes from Benjamin Graham. The intelligent investor is a realist who sells to optimists and buys from pessimists. And I think the key takeaway here is that, what we look at as the share price is almost what people's emotions are. And in the short term, they're a voting machine. In the kind of long term, they're more of a weighing machine. That's the key driver for a lot of value investors. So to distill the secret of a sound investment into 3 words, we venture the motto margin of safety. So he was always really keen on this concept of margin of safety. And we'll probably do a video at some point around what that kind of means as well. The investor's chief problem and even his worst enemy is likely to be himself. And I've found this on a lot of occasions where I've made judgments and I've almost questioned myself, even though I personally believe something is good value. I'd almost second guess myself and either not make that investment or make it at the wrong time. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. So I think this is the key takeaway I always keep in my mind. An investment operation is one which, upon through analysis, promise safety of principal and adequate returns. So you've always got to look at that concept of safety and then the returns that safety provides. Obviously, depending on your risk tolerance, that can obviously change. You are neither right nor wrong because the crowd disagrees with you. You're right because your data and reasoning are right. And I think this is an important concept. I think this is why a lot of people just follow the hype. They then end up getting burnt because they don't understand why they've invested in something. And this is why I'm so keen on getting this education out there, because I think the challenge is people buy something because someone else is buying it, their neighbors bought it, it's trending on X or some other social media platform, rather than truly understanding what they're buying and why they're buying it. What is it doing for their portfolio? Buy not on optimism, buy on arithmetic. So being a value investor, it's really important to understand the fundamentals of a business and understanding its true value. If you're shopping for common stocks, choose them the way you would buy groceries, not the way you'd buy perfume. I think this one's quite interesting, right? How would you decide on buying a stock and how do you judge them? I've always found this a bit quite difficult because there's different stocks that I believe in and there's different stocks that just make sense from a mathematical perspective, less around the potential of that business. And a lot of people, we see this a lot with Tesla, right? Tesla, people have put a lot of money into Tesla because they believe in the vision of Elon Musk and where he's taking Tesla. But from a valuation perspective, the numbers don't quite add up. So investment is most intelligent when it's most so, treating an investment as a business rather than anything else, looking at the numbers rather than following the hype, the trend. I think that's quite key. I think a lot of people don't like ARK for that reason. They feel like it is very much treating it as a future thing rather than almost a business. Now, I don't believe that to be fully true, but I can understand why people might think that way, the way that they've invested in some of the funds over time. Those who don't remember the past are condemned to repeat it. And I think this is also crucial when you're doing investing. Is we always talk about the past not being representative of the future, but I think it's about learning from your own investment mistakes over time. And I almost feel like you almost need to go through that journey yourself. It's one where I thought, oh, okay, you could probably teach people not to make those mistakes that you've made, and don't make those brash purchases. Don't put all of your eggs in one basket. All the common sense things. But I think the reality is you almost need to go through it yourself, and you just got to be really mindful and say, okay, I did that before. It didn't work out. I need to spend a bit more time thinking about it. So I think this is a really good one. The individual investor should act consistently as an investor and not as a speculator. This is a real big one for me. I think this is why I've always struggled with Bitcoin, actually, because for me, Bitcoin is still quite in that speculative play area. That doesn't mean I've completely removed it out of my portfolio. I do use a lot of proxies in the form of things like Coinbase, a little bit of MSTR. Now that there is these ETFs around Bitcoin, I've contemplated putting some money into those ETFs. And now the regulatory side of things, certainly in the UK with the FCA, has changed slightly so that it has made it a little bit more easier to invest in Bitcoin. But I'm still concerned around the regulatory space around it. And for me, it's still a speculative play. Although in the future, whether it does become a hedge against the markets like gold is and silver is, we're not there yet, in my opinion, and the data proves that out. But I think in the future, there is that potential as the concept of Bitcoin grows and stable coins in particular grow. It's absurd to think that the general public can ever make money out of market forecasts. I think this is an interesting one, bearing in mind the time horizon that this guy was working in. I think this has changed in the modern age. We've got access to a lot more data, and we've got access to more information than we've ever had before. Having funds, and we'll talk about another investor who created or seen as one of the fathers of ETFs. I think over time, this is one of those things that's getting easier for investors. But again, almost too much information is just as bad as too little information, because I think people get confused. There's also a lot of funds that overlap, and then people look at their portfolio. And then when you look at the concentration risk, you can almost over diversify and get no returns nowadays. Or you think you're well diversified and you're not. So I think this one's an interesting one. A stock is not just a ticker symbol, it's an ownership interest in an actual business. I think this one's brilliant, because I think especially now in the modern age where it's so easy to buy stocks, it's so easy to buy fractional shares of a stock, people don't really know what they're buying, and they don't appreciate they're buying a business. They think, oh, okay, I'm buying something that's going to go up over time, but they don't appreciate that when you buy Apple stock, you buy Tesla stock, you are buying a proportion of that business. You are believing in that business growing over time. And yeah, I think certainly in the modern age, this is a lot more truer than before. It's so easy to buy, it's so easy to sell, and it's so easy to disconnect a ticker or a chart to a business. Even the intelligent investor is likely to need considerable willpower to keep from following the crowd. I think this is so paramount that when Tesla was on a run, when crypto was on a run, everyone was dumping money into it without really looking at the fundamentals, even if they were driven that way. And I think it's really hard not to just sit on your hands. Warren Buffett was brilliant at this. He would just sit on his hands. He would talk about his circle of competence. He'd talk about risk. He'd talk about value. And he just had the real propensity to do nothing. And doing nothing is the hardest thing as well. It's not just following the crowd, but it's the willpower to just sit on your hands and trust your instinct on why you originally invested in the first place. That doesn't stop you going and revisiting it time to time, which is what Warren Buffett used to do, and then sell it if he felt like something had fundamentally changed. But just that willpower to just, not follow the crowd and literally do nothing. The defensive investor must confine himself to the shares of important companies with a long record of profitability and operations. I think this is another key area. We often buy companies but we don't necessarily look at their long-term view of how long they've been profitable. There is some indices that do track these. There are some that track dividend kings or dividend aristocrats where they've been paying dividends for a long time. And normally when people and companies are issuing dividends back to you, typically is normally a sign of stability because they're able to use their leftover cash. They've got nowhere else to use it within the business. They're distributing it back to you. And when you've got companies that have stable dividends that have been growing over time, they're normally fairly stable, profitable companies. So again, looking at companies that are stable is quite important. And then finally, Wall Street people learn nothing and forget everything. I think this is probably the most crucial one for everybody, not just Wall Street. Quite often we forget why we've invested in something, the purpose of that investment, challenges that have occurred with various investments. We typically just look at the next hype thing and go back to where we were when we started. So there you go, guys. I thought it was quite interesting to share some of the principal values of a very famous investor over a period of time who actually got very good returns, was actually mentoring some of the biggest investors in the modern age, like the forms of Warren Buffett. Let me know in the comments, by the way, whether any of these principles make sense to you. Are you interested in value investing? Do you believe in the concept of value investing? It is quite a unique way of investing. I do it from time to time. So during COVID, I took advantage of a lot of companies that were, in the dip that I felt were good value. And I spent a lot of time understanding the value and where the returns could be. But there you go, guys. Again, treat nothing here as financial advice. Do your own research as always. And I will catch you on the next one.